some interaction and some questions, so which I'll direct from the chair. But welcome, Duncan.
Thanks, Paul. Very good. So good afternoon, everyone. Yes, I'm a farm business advisor. I work mainly through Western Victoria and South Australia, and I have a particular interest in leasing, so I was involved in writing Successful Land Leasing in Australia, which is a REIDIC publication, and I also did a Churchill Fellowship looking at leasing in the UK, the US and Canada, and that informs a lot of what I'm talking about here today. So it's a tight time schedule, so I'll try and stick to 20 minutes and not expand too much on my slides, and if there's questions at the end, we can go through those. So my focus today, first sort of two major areas. Can a farmer's management consistently allow their farm business to beat the return available from land tenure options? So bottom line is, can your management return beat the return you would get from leasing your farmland out? And imagine most people I'm talking to here today, that's the case. So more of what I'm talking about is the opportunity for all those who can't achieve that to lease their land. So if you can, how can additional profits be earned? How can you take advantage of that? And if no, for those farmers, how can they transition from farmer to landlord, or perhaps share farmer or a contract farmer? And then, as John Mulvaney said this morning, it is all about people. So obviously looking at a few scenarios today, but the scenario of the person and their situation, their family succession planning, their background are all the key items. So there's a lot of variables that go into it. So briefly, the return from an agricultural investment is the return from the land and the working capital. If I flick through these a bit quick, everyone's going to get a copy of these, so I just want to get to the key points really. So if we're looking at the two sides, traditional farm business in Australia, or not a traditional, but some farm businesses make no money from their working capital from their own management side, and they rely on the land appreciation to make a return. Now we want to situate this because it's at a time where we've got some good new information on land values. So this survey we heard about last night, which is from the Ag Answers team, and I think it's a great piece of work because it gives us some really good long-term information. And it shows that farmland has had a very solid long-term return and is a good asset class to hold. So that underpins really what I'm talking about here today. In Victoria here we're seeing 5% annual growth over 20 years, which is a very solid return. New South Wales 6.1% for the same measure, and South Australia 5.6%. So obviously the more reliable country hasn't probably gone up as much. It was higher to start with, but that's that survey here that we talked about last night. So underpinning all of this is a very solid return from the farmland. And the other side then to the story is the return from management that the farmer manages to produce. So this is from the ABARE data saying farm cash income and farm business profit. So farm cash income is what I'd refer to as farm cash operating surplus. That's gross farm income minus direct farm expenses, or farm expenses including overhead. And then the farm business profit is when you take into account the change in inventory, but take away an allowance for depreciation and also the owner's salary equivalent effectively. And it shows how where the most Australian farm businesses sit, and if you take into account that sort of profit measure, the low profitability of a lot of Australian farm businesses. Now obviously within that we know there's a huge variation in farms. So if we look at it more broadly, the top 25% are making good profits, and that's where perhaps say that's a 2 to 4% return. And thinking back to those land values, 5% long-term return on land values, so we're putting the return on for a good farmer at 7 to 9%. And then there are the bottom 75%. So the bottom 25%, and this remember is farm cash operating surplus, it's not that profit measure. So these are farmers whose farm cash income is not enough to cover farm operating expenses. So I'm sure everyone understands there's some variables in there. There might be some pasture development costs and fencing that can be expensed, so that makes that expenses look higher than they might in a normal year. But if we allow for that, there's still a huge number of farmers in Australia that are making a very low return. And I guess my point about leasing is that many of these farmers should consider leasing to these farmers. And if that occurred, that would dramatically change the farm landscape. Now put the other side to this is if you own farmland And you often, if you're advised to retire from farming or move out of farming, you'd be advised to sell that land and invest off-farm. What has been the return to off-farm assets? And since the GFC, the picture's a lot more cloudy than it perhaps has been. At the height of the mining boom, it probably looked pretty clear. There's some real opportunities, and everyone felt a bit like they were missing out if they weren't in the hot stocks. But if we look at the long-term returns, Australian shares gross returns for the last 10 years is 7.1%, and that's with dividends reinvested. That's the growth that's comparable to the figure I mentioned for farming. And you can see that there's no sort of standouts there, and really the return I mentioned from farming, from the combination of farmland and the income, is very comparable with that. So it's, I think, a very good story for the strength of the farm investment. The other side to this, though, is if you were someone who retired, you're not going to be in one hot stock that's returning above that. You're probably, if you're retiring, you're going to be advised by a financial planner to get into a balanced fund, so the return's even lower. And if you look at the superannuation figures that were released recently, they said it's the 10-year return for a balanced fund in a superannuation fund is 5.6%. So if you're a retiring farmer and they advise you to, with the stage of life and risk you're looking at, that's the sort of return you're looking at. So 5.6% compared to, we're saying 5% for land value and then the management return on top of that. So bottom line is, I think the farmland, the idea of a farmer retaining their land even in retirement and leasing it out is a good model from the return. And that just so happens to tie in with what many farmers want to do anyway, because they've got that tie to the land. So I guess that works quite well. So tied to this is the sort of trend in Australian farming as well, though, that there is a relentless trend to larger farms. In the last 40 years, we've seen the number of farms decline dramatically, and the farm size is growing. So the big, I'm not always a fan of the big is better mantra. That certainly doesn't have enough nuance to it, but there's definitely a trend towards larger farm businesses. And if we look at farm size, 10% of Australian broadacre farms account for 49% of farm sales. And the Australian Farm Institute studies, however, said that that right through this profile, even with the large farms, it's still based on family farms. So there's a lot of talk about corporate farming, and I'm sure it's expanding, but the family farm is still the dominant enterprise, even in this large farm sector. And that, I think, emphasises the importance of scale. And at this point, I'll just address one of the topics that's listed in my talk there about helping young farmers. So my Churchill report focused on helping young farmers get into farming, and I was interested in seeing if anywhere in the world there was a leasing model or a farm share model or a share cropping or some sort of model that someone had that helped young farmers get into farming. And really, nowhere in the world has found a solution to that. They'd all said it's very difficult. Basically, if you help someone get into a large farm, you're helping them into a very large asset. So it's a difficult proposition. But, and again, if we come back to the people argument, no one starts out with a blank sheet, do they? 100% equity in a very large farm. It's down to the family succession, how you got to that point in the first place. But I would say that if farms in this lower area obviously can't rely on economies of scale, so I did see some good examples of young farmers getting into farming through leasing, and then they had to adopt a different strategy to just a commodity-based approach, and they'd developed branded products in a focused market. But it's obviously a very different focus for a young farmer to go to that route than it is to look at being a sort of broad acre producer. So there are many small farms in Australia which don't provide an adequate living for the operators. Many of them would be better off if they lease their land to larger farmers. Leasing and share farming are two options in Australia that can be used in conjunction with each other, and contract farming is the best model. So I looked at about 10 different models when I travelled around on my Churchill Fellowship, and contract farming was the most interesting one, and I'll outline that briefly at the end of this talk. So if I'm focusing on leasing, saying that's where the opportunity is, what's happening with leasing in Australia? There is a shortage of supply, so there's not a lot of leasing being offered to the market. Leasing, there's about 5 to 6% of Australian farmland being offered to lease. It's probably increased a little bit, but there's definitely a shortage of supply. There's a lot of people who would like to lease, but how do you secure that lease? The other problems are that the land condition at the start is often run down. It's quite common that that farmer who's never made any money themselves then expects top dollar for that land. So you're seeing grazing leases for some onion grass and they're asking the top dollar. Very common situation. So there's also a lack of or poor formal agreements. And though if it's not carefully specified what the conditions of the lease are, that leads to mining of the land and the land at the end's in a poor condition. So for those sort of reasons, I think leasing's got a bad name in Australia. Leases are also often short term. There's a lack of process during the lease, so too much handshake, she'll be right approach, which sounds great, but it is a recipe for disputes at the end. And there's not enough process given into the agreement and also the condition report at the start. Both parties agreeing what was there, what condition it was in, what we were starting out with, soil tests, that sort of thing. Low interest rates don't help because a lot of people will look at it just say, I could borrow the money and buy it and it'll cost me less than leasing at that rate. That's fine, but it all depends on your equity and your own personal situation. And the expectation of owners' price as a percentage of return, that's a big problem, I think. If we look at that slide there, which says land value per hectare is here in orange, showing the last up through to 11-12, and farm receipts per hectare is flat, basically. So if you link your lease value to a percentage of land value, it's really not fair to the farmer, is it? Because their return's not tied to the land value. So that's where in our book Successful Land Leasing in Australia, we talked about ways to value a lease that were not related to the value of the land. And they're based on a percentage of the gross margin. And that'll obviously, 50% of the gross margin will be a fairer result. But it won't give you the top dollar. So I guess that's part of the conflict there. And the bottom line is, though, there's very limited leasing, whereas you look in the UK, leasing's about 50% of farmland, and in parts of the cropping areas, particularly Iowa and Minnesota in the US, it's 60% of farmland. So there's a huge market for farmers to expand, to get started. There's a lot of options there. So I think that large market creates options for other farmers. So impediments to the growth of leasing. Another factor that often puts people off, they go to their accountant and the accountant says, well, if you start leasing, you're no longer a primary producer, all of your sheep are deemed sold, so you've got a big tax problem, all your FMDs come in as income in that year. It looks bad, well, we don't do it. So that puts people off. But there are ways to manage it if people understand a bit better. There's a poor investment in the intellectual capital around leasing. It's relatively rare to find a lawyer with any understanding of these issues. I've seen farm leases where it talks about replacing shop windows in the fine print, so clearly it's just been pulled out of the main street of town. That also includes very few condition reports of the start point of the lease, so the understanding of what the condition of the land is poor. And many older farmers don't want to engage in the process as well, so that's a difficulty. So I think there's enormous scope for expanding leasing in Australia, and I think that's a huge opportunity for the best farmers. But the challenge probably for those best farmers is to convince those who should lease that it's a good idea for them, good solution. Right. Okay, so I've got a couple of models and looking at leasing, how you incorporate leasing. So this model, just quickly, we're saying, here's a farm business, has no off-farm assets. How does this farm business use leasing for succession planning and retirement? So it's just a 2,000 hectare sheep farm, has 12,000 sheep, liability is 1.15 million, so 87% equity. And using leasing, this business is transformed, half the land sold and leased back, and the assets are then used to invest in off-farm assets. So if there was a number of children here, one coming back to the farm and some not, there's farm assets secure the economies of scale, and the off-farm assets are developed with the same equity. As I've emphasised, that's why I've emphasised the point, the importance is the lease agreement, the long-term farm lease agreement that works. that is well set up and is reviewed annually and is ticking all the boxes for long-term security. So a lot of, you certainly wouldn't want to do this with a short-term handshake 3-year lease, obviously. But a lot more of the opportunity if you're selling to someone, and I've seen a number of these occur recently where land's been sold to an investor and then leased back. So I won't to discuss that. Another model using leasing. So this is the same, similar farm model, but higher debt. So 3 million, so equity is 66%. And equity starting to slide down to the point where the farm business has no longer got the resilience of equity to rely on in a poor season. If this business is restructured with the same model, a long-term lease and selling land, the debt can be paid down and some non-farm assets can be developed and the equity is improved to 88%. So 2 models that use leasing. Now another model, using leasing for expansion. Here's a farm business where equity is at 75%. It depends on how much land they're going to buy, of course, but if a farm business is looking at expanding, how does it expand when equity is at 75%? A significant purchase might push them into the 60s, and it might then put too much stress on the business and lower its resilience. So it's an example where leasing can then be used to increase the scale of the business without. And this is where that low interest rate point is at the moment, I guess, where people are saying, well, I could buy and have a low interest rate, but it also then significantly lowers the farm equity and puts a bit more stress on the business. So leasing's still got a role to play. Now, options for, I've emphasised leasing. Leasing with some share farming preserves a farmer's primary producer status. So if you're the landowner, that can solve some of those tax issues. The other version that I'll talk about briefly is contract farming. And there's also, I guess, opportunities, I think, if you find an investor, it doesn't have to be a foreign buyer, it could be an Australian investor, to buy a farm and you lease it from them. And they could have the benefit of a house if it's on it or that sort of thing. So I've discussed leasing. So contract farming is very big in the UK. So this is the model I thought was the most interesting and applicable to Australia. And it's if you don't want to have the full risk of leasing, so very suitable for someone who wants to share the risk with the landowner. The other attraction of this model is that it's on the next slide. I'll just go through to the model. The other attraction of this model is both parties remain as primary producers, so it's a key attraction. And also, a lot of times I talk about leasing to someone and they say, well, next year's going to be a great year, everything looks good, low interest rates, good commodity prices at the minute, which is occurring now. I'm positive about the future. So to lease and really take out all that production exposure in farming is one of the reasons people don't want to do it. So this leaves in the profit. So this example here is a sheep example where the farm business has its total income, some variable costs, and then the contractor is effectively what would have been the tenant in the leasing model. So that's the farmer coming in to work, and it's a great mix, I think, where potentially the farmer is the landowner. The landowner might be at the point where they have extensive experience with that land, they know how to run it really well, but if you think of John Mulvaney's career life cycle, they might be in that top part coming down. It's a sensitive topic in my experience with talking about to someone who you think is on that curve, but we're talking about a physical industry where there's not as many workers as there used to be, so everyone's going to get to that point where the physical work's not what they want to focus on, but they want to still use their experience in their farm business. So this is something where I emphasise that the farmer is the landowner and they are using their experience, and the contractor's the young farmer potentially coming in, and they are bringing their enthusiasm and their energy to the business. So that combination, I think, can work well. So basically, they both get what's called the basic remuneration. So the contractor gets a remuneration that effectively rewards them for the ownership of the sheep that they're bringing. So they bring in the working capital and the and do all the contracting work, and then the farmer's return is basically what they get if they lease the land and allowed about 10% to reinvest back into maintenance on that land. So they both get a sort of base return, and then the upside to it is they're both exposed to the outcome of the farm business. So the divisible return's what's left, and in this case they get 50-50. Now that return could be varied depending on the risk profile. In the UK, the risk that the contractor wanted to take, the young farmer in this example, say, if they didn't have the resources to cope with a bad season, they might only want to take 30%, it would be 70-30. So they would get 30% of this divisible return. The flip side to this is in a loss year, they share the loss in the same proportion. So effectively, the landowner is continuing to farm with an exposure to the outcome. They're getting the equivalent of the lease payment plus the outcome. This sharing component, I guess, is where they share the outcome. And when we talk about generations as well, I think of young farmers. I think a lot of young farmers, they're not, or they talk about young people, they want to be more engaged in the business. I think nothing engages people more than having an exposure to the outcome rather than just being there for a salary. So if you're exposed to what's happening, your focus and interest in the business is going to be a lot higher as well. So their final return, then they get a share of the divisible return, and there's the breakdown of what they receive at the end. So both get more than if they were just a contractor with the livestock or if they were a landowner leasing the land out. I've also got a cropping example. So the two together, obviously mixed farming, cropping and sheep is a very common model in Victoria. So the two could be combined together. So in conclusion, farmland values and farm income compare favourably with long-term returns from other asset classes. Any farm business hasn't been able to consistently generate more profit than they would from leasing should consider their land tenure options. And I think that represents an opportunity for all the good farmers to take advantage of. And the contract farming model is that I'm saying there are some variations that could be used in transition to a full leasing model eventually for that landowner. So that farmer might be looking to retire and they move out of farming through a contract farming model and eventually lease it out when they want to remove all of their production risk. Thank you. Are there any questions? The question was that if you lease your farm out, you're no longer a primary producer, you lose all the benefits of a primary production tax advantages, and that's true. So leasing, I think, can be used with a component of share farming, and then you preserve your primary producer status. It really then depends on, to compare to contract farming, as a contract farmer, both parties are primary producers and they run the farm business together and they share exposure to the risk, which is the key thing. So it is attractive in that regard. I think the upside is probably what appeals to people as well, that you keep exposure to an upside of a really good year, whereas if you lease the land out, you're just getting a sort of risk-free return, which has its appeal in other ways. But to get back to that tax side, it is possible to lease and retain an area as a share farmer and then preserve your primary producer status. So there's ways around it that way. Yep. Yes, so I've got a bit of a handout that I'll make available that's got more detail so you can see the detail. But basically, the variable costs are allocated. If I go back. Many of the variable costs are in here, so the contract, so for this one, so the cost of the drench itself will be in as a variable cost to the business, but the costs, say, of what might have been a contractor cost to get someone in to do the drenching, that will be part of this reward here for the contractor here. So longer term developments, things like gypsum that are going to increase the asset, that would have to be, I guess you could expense it and then the depreciation over a bit more management accounting involved, and that's what I was getting at with some of that farm expense stuff often overstates expenses when it's a long-term cost. Yep. The question is, success around a hybrid model where there's leasing and some share farming. And the reason why I haven't emphasised much share farming, and when I went on my Churchill trip, share farming's on the decline everywhere, is because of the trust issues involved. And there's definite problems with how to manage a share farming agreement, and also what the split is. It used to be 70-30, say, for cropping. Now it's more like 80-20. So there's often a lack of knowledge about the costs involved. So the short answer, I guess, is that the best one, I do have about 4 or 5 going with various clients, particularly where they've retired. That's the best one, where they retire and have a small area of share farming. And it's generally with the same person, the same farmer. So they lease and share farm with the same farmer. And there's trust involved, and I guess it's a local person, and there's got to be trust, and they've both got to be farmers, is the bottom line for share farming. And that's often where the difficulties are. So I think it's why it's on the decline, really. Yeah.